Welcome along, everyone. Tonight's presentation hosted by myself and Marcel Jacobs. I'll just move the screen around and we'll get right into the presentation. Tonight we're having a little discussion and talking about our financial future and the importance of having a plan in place. And I'd like to welcome along Marcel Jacobs, who's a licensed financial planner. Okay, so let's get right into it. So who would like more freedom, more money and more security? I think we all would, the ideal lifestyle would all have more of the above, and I'd like to create that financial freedom. So tonight's presentation, we're going to come up with some of the things, some of the questions really we should be asking ourselves, and some expert opinions from Marcel, how we can plan to give us more freedom, money and security. The real stats are quite shocking actually. 80% of Australians will be on the pension and relying on that for support. Many will be forced to sell their family home, which is obviously quite sad, and less than 1% of the population will retire early. So I think as Australians, our goal is to have that great lifestyle, retire when we can still achieve it. But the facts there state that most Australians are not going to be in that case, but it doesn't have to be that way. We can all make changes, and the sooner we start planning to factor in retirement and what we're going to need and how we're going to get there, the more chance we're going to achieve that early retirement, or relying on our own assets to support ourselves into retirement. So these are some of the some of the stats on the current Australian pension, and it's quite shocking really. So according to the government surveys, a single person in today's climate at retirement needs about 45,000 a year to live comfortably. I think that's a pretty modest income. The reality is the single age pension is currently 25,000, so we're well short. So if our goal is simply to rely on the pension at retirement, it's going to be a pretty tough gig. Looking at a couple, saying we need about 64,000 in income. The government pension is currently 38,000, so quite a scary difference, and the reality is that the number of people in retirement is growing as we're getting an aging population. People are living longer. And at some point, I think the government, Marcel, will have to look at that.
Yeah, absolutely. Because, like you say, that those figures that's a big discrepancy between the comfortable and what's on offer from the government, and it'll get tougher as the years go on. The reality is, though, we've had as workers earning money and receiving contributions, we've got that income stream to be able to invest in super. And if you do, that is, if you do take control and a bit of responsibility to make sure that money's invested well and grown over time.
Thank you for that. My name is Geoff Tomkins. I'm going to be your host tonight. So I've been a long-term property investor, built new properties, renovated, done subdivisions, always had a passion for property, and I got my real estate license in 2014 and currently property buyer's agent. So I'm in the market looking for properties for my clients as well as my own portfolio. I've seen many changes, over the last 30 years of investing, and the growth in the value of property is quite staggering. Hard to believe when I look back 30 years ago, 40 years ago when I bought my first property,
Yes, yeah. Well, we've got some good slides to show everyone around the compounding of returns and property prices. So we'll get to that shortly.
I'd like to introduce myself and please explain a little bit about yourself as a licensed financial planner.
Thanks for the intro, Geoff. I've been in financial planning for 20 years now. It was back in 2002 I started my journey. But yeah, I run a practice on the Northern Gold Coast. We service a diverse range of clients, and we're quite holistic. We look at everything from budgeting and cash flow through to investment, superannuation, insurance. I was talking to a doctor just the other day, and I was trying to explain what we do and how we do it. And the analogy that I used is we're almost like a GP. We look at everything for a client, but if a specialist is needed, property investment, legal advice, or specialist tax advice, we revert them to the right specialist. So that's probably us in a nutshell. And we're goals-based. So we rely on our clients in terms of what they're working towards, what their goals, what's important to them. That's the driver behind any advice that we provide.
Thank you, Marcel. So a general disclaimer there. So Everyone's investing situation is different, so we always recommend that you seek professional advice before investing in the asset class. Again, tonight we're going to cover some generic content and give some examples and really give the facts on the market. But we would always recommend that you speak to Marcel or a licensed financial planner before making any of these, investment decisions, because everyone's situation is unique. I'm sure you've seen the diversity, Marcel.
Yeah, what might be appropriate for one person might be, not right for another. So yeah, that advice process is really important to get specific advice. But yeah, keep today general, and it's more about education, really.
Perfect. So what will you learn tonight? So we'll learn about the cost of delaying your financial plan, why the purchasing structure is so important, and the security blanket of financial plan will give you, and Marcel's going to really dig deep into each of those three topics and give you a lot of education, a lot of information, and how important and how the different dynamics can really work.
Yes. So the cost of delaying your financial plan. So we see this often. We've got a diverse range of clients from early 20s that are just starting out right through to people that are retired or even moving into the aged care kind of space. So we've got a very diverse range. But when we talk to people in their 50s and we meet them for the first time, there's often a sense of panic or concern. They may have left it a bit late to plan for things, but that's where we come in and try to fast track things and make sure that they get to the place that they want to. Whereas talking to younger clients, it's about getting the foundations right and getting a plan in place that they can follow right through to those later years. And by starting early, that's the key. To give you a very quick example, we met with a young business owner a couple of months ago, only 23 actually, and part of our strategy was to get her superannuation balance to 100,000 by the time she's 25.
Oh, wow.
And you might think of that, look at that and go, well, gee, she can't touch that money for a long time. We understand that, but there was more to it than that. So anyway, we got this so the target's to get 100,000 by the time she's 25. And the reason for that is once she hits that target, she then doesn't need to do anything further as far as contributing huge amounts when she gets to 50 or 60 into super. If you just let that money go and compound over time, we worked out just with normal contributions along the way, standard income, that gets up to about 1.8 million.
Wow.
Just from that 100,000 growing over time. So really important to start early. And as I just mentioned, the power of compounding. On the next slide, we'll take you through a simple example there to show you what the differences are. And yeah, because if you're starting early, you get the things in place, strategies in place, investments, superannuation, all those things that are important for later on in life. When you get to that stage later on in life, your assets are working for you literally. They're growing while you're sleeping, much the same like with property for your clients that you see investing early.
Yeah, like case of example, the last sort of since COVID, property prices we've seen all around Australia have climbed dramatically.
Yep.
And our values have gone up 100, 200, 300,000 on the average home. And the clients haven't had to do anything. They've just sat on their asset, and it's just grown in value.
Yes, yeah, absolutely. So yeah, the power of compounding is very important factor alongside getting good advice, strategic opportunities, tax minimization, that type of thing. And just the last point, this is really important for us as a business and as an advisor, is achieving that balance between, yes, building wealth, preparing for the future, but also enjoying life along the way.
Right.
There's more to life than just saving every last penny. It's important to have that balance between lifestyle and building wealth.
Sure.
Okay, so here's the slide that I just mentioned. Very simple. So down the left-hand side is the value, and down the bottom is the time, which is 30 years. So here we've just got in the blue shaded area, year one, someone invests $100,000. And as you can see, that grows steadily over time. We're not shooting the lights out with big crazy returns. This is a standard return profile of around, I think it was 9% that we used, versus someone with the exact same investment amount, the red shaded area, but just leaving it for 10 years, like not making a decision
Right.
to invest until a 10 years has passed. And so you can see there at the 30-year mark, the impact of compounding for the blue shaded area. That $100,000 grows to 1.25 million versus the red shaded area who waited 10 years, only getting to not even half of the blue shaded area. I think it's just over 500,000. So a really important factor.
Yeah, it really shows the impact of, starting the sooner you can start,
Yes.
never too late, but the difference over time, and you may not see it in the first few years, but you can see in those graphs over time, 10 years means you're going to end up with more than double the original investment or return of the, as opposed to delaying it. So.
Absolutely. We've thrown this in this slide almost last minute, didn't we?
Yeah, it was. Yep.
Yeah. In this one's highlighting inflation, which is almost the reverse of compounding. So inflation, and it's all over the news at the moment of how high inflation is. But more importantly, over time, inflation essentially devalues money that's just sitting in a bank account, for example. I mean, it's a nice feeling to have cash in the bank as a cash reserve and something to fall back on. But that money can go back in value because of inflation. So this graph is just showing, it's over a long period, but starting off at $100, if it's sitting there earning no interest, and we look at the green line, which shows inflation at 5%, that $100, even after 10 years, if it's just sitting there, would only be able to buy $60 worth of goods. So that's the impact of inflation.
So you've lost nearly half the value in inflation of its original value.
Yeah, exactly right. So even in the current market, so you've got some notes there that the inflation rate of 7.3%, that was over the last 12 months. So $1 over the last 12 months is, can only buy. What's that? 93 cents. 93 cents. Yeah. So
I think it just shows the effect of having money in the bank.
Yeah.
It's a great security blanket, but in the current inflation rate at 7.3%, that 100,000 invested 12 months ago is now only worth $93,000 in real borrowing power. So money in the bank, it just shows actually going backwards,
Yeah. And again, this is a good kind of financial planning type discussion to say, well, what are your goals? What do you want to work towards? Do you actually need 100 grand sitting in the bank? What else can we do with that money, but still allow, maybe where you need to keep 20,000 as a bit of a cash reserve. Let's do something else with the 80. So that discussion is really important.
So I guess that's where you look at a case by case basis, Marcel, and judge, what the person's got in other assets and their risk profile and their employment situation and all that, and work out what they need as cash reserves and what they can afford to invest and where to invest. Yeah,
exactly right. Exactly right. So moving on. Okay, so we're just now jumping into purchasing structure. So this is often something that's not covered specifically. So we thought we'd just raise this because it's quite an important area and can be an opportunity for some as well. So when we're talking about purchasing structure, we're talking about who owns the asset when you purchase the asset, whether it be property or shares, etc. So the most common way is to buy something in your own name.
Yeah, sure.
Followed by a family trust. I mean, there's lots of different structures. We've kind of handpicked three here.
The three main ones, I guess, the most common ways people.
Yeah, true. So family trust, and then also a self-managed super fund, which we'll touch on briefly here. So firstly, personal name. So in your own name, from a finance perspective, I mean, you do a lot with brokers when clients buy things in their own name. That process of applying for borrowings is quite simple, straightforward.
Yes.
In comparison to a trust or a structure of some kind.
Correct.
Tax benefits, specifically, I put this point in just around access to capital gains discounts that flow through to personal.
And also, if we're talking about property, the tax benefits, the loss of the deductions we can claim against the property, we can actually claim that back on our personal income tax, which aids our cash flow for the investment property. Yeah. And the higher income or the higher tax bracket, the more benefits it has. So that can be quite a helpful aid to our cash flow of our investment property as well. Yeah, because there's still negative gearing strategies out there.
You deal with them all the time, which yeah, it doesn't flow through in a trust. So yeah, we'll touch on that shortly. Low cost and simple. Yeah, I think borrowing personally is probably the lowest rate of interest that you can get, I would say.
Definitely, and you've
Yeah.
got more range of lenders as well.
Yep.
So your finance specialist will have a bigger range,
Yep.
more options, and yeah, as you said, generally what I've seen in the past is generally a better interest rate because the banks, you know, like that.
Yes.
Because we're assuming some of the risk, I guess, you know.
Yeah. Yeah. So and just as a risk, bankruptcy or having assets at risk, and this is probably more important for self-employed people. People that are in litigious kind of roles where if they make a mistake, that can come back to haunt them. So any assets in your own name, if you're buying properties, if you're buying shares, any type of asset would be on the table for lawyers to get at if you've done something wrong, even if it's by accident. So that's where other structures can come in and provide some kind of protection around those assets. And also estate planning, which is not often talked about, whereby you know, in the event of death, those assets can be passed on to certain people that you might not want to receive those funds, especially if there's divorce in play, or you know, all these different things that come into play in the event of someone's death. And I've seen it many times in scenarios where assets go to places where people put a claim on estates and they go to people that they don't necessarily want them to go to. So
Right.
Moving on from personal name to a family trust. So yeah, we recently looked at a family trust for a client, and the big driver for this client was, well, there were two drivers. There was the tax planning element,
Right.
and also the protection element as well. This client is actually a doctor as well, but essentially with the trust, it's a structure that holds assets, and the legal owner of the assets within that trust is typically the trustee. Well, it is the trustee, and if a trust is set up for protection purposes, that trustee is different to the investor. So the person that's put the money into the trust to buy the asset, there's some separation there. So in short, the investor that buys assets through the trust is not the legal owner of those assets.
Right.
So back on the example before, where if there is an issue there with a legal consideration that they're dealing with, those assets that are in the trust are off the table,
Right.
if you like.
And I'd just like to add something to that. Many years ago, I was looking, purchasing investment property, and we signed the contract in a family trust name, the business in the trust name, because I thought it was safer.
Yes.
But we actually couldn't get funding. So
Okay,
I'd
that's
advise
another,
it, because the way the loans work are different. So
Yeah.
again, coming back to your financial planner and your property specialist and your mortgage broker,
Yeah.
it's really important to get that advice to make sure it is
Yeah.
the right structure, it's going to
Yeah.
work.
Yeah, and that's, yeah, I just kind of, in addition to that, we're only scratching the surface here with these types of structures. It's a very specialist area. It's something that you talk to your accountant about. You get legal advice to make sure it is appropriate. Tax planning. So with the trust structure, so you've got the legal owner, who's the trustee. Then you've also got the beneficiaries of the trust.
Right.
So the beneficiaries of the trust are can access the beneficial recipients, or receive benefits from the trust in terms of distributions or capital gains, and so that can help with tax planning. The example that we were dealing with the other week was a doctor who wanted to be able to distribute income to his siblings and greater family overseas. So he's able to do that moving forward.
And can you just explain that, like the tax implications, you know, property outside of in your personal loan, you can claim the tax deductions. I believe that's not the case with the family.
Correct.
trust.
Yeah. For any losses, so specifically negative gearing, any negative or losses in an income year, they get retained in the trust.
Right.
So they don't flow through to the beneficiary as a tax deduction. They get trapped in the trust, but they can be used and offset in future years.
Right.
If the trust becomes positively geared.
Okay. And can I ask one question? I just thought of in the family trust structure, the tax rate. So we all, if we buy an asset in our personal name, it's based on our actual income tax bracket. In a family trust, is it taxed at a company tax rate or a flat rate, or does it vary depending on the income of of the family trust.
Yeah, so it depends on who receives that income.
Right,
So with a trust, so income can't be retained in the trust.
right,
There's actually penalty tax if the
Oh.
income's not
Right.
distributed. So the income must flow through the trust to a beneficiary. So if it goes through to, an 18-year-old who's got a part-time job and not earning too much, that income will go through to their marginal tax rate, which might be zero.
Okay, right.
Whereas goes through to someone earning the big dollars like yourself,
Right.
tax at the highest marginal tax rate.
Right.
So yeah, it depends on who receives the income.
Okay, and you can select how it's distributed between the owners of the trust, the income. So you can have parties. It doesn't have to go equally to, say, if there's two parties, for instance.
Yeah, you can depending on the rules of the trust deed, if that's allowed to happen, which that typically would be.
Right.
You can have it go through to a person that's a beneficiary. You can even have it paid through to a company.
Right.
The company is on there as a beneficiary as well.
Okay, perfect.
So, and just finally, a self-managed super fund. So different beast altogether, but still a trust, mind you. And likewise is every super fund. You know, if you're talking Australian Retirement Trust, Australian Super, Post, Rest, they're all super funds and they're all trusts. Self-managed super fund, same structure, although the trustee, the person that's legally responsible for managing, is normally the members, being themselves, if you've set up a self-managed super fund.
Right.
But greatest flexibility when it comes to investment options. So if you look at, for example, Australian Super, they've got a few tick box options where you can choose growth, high growth, balanced, and
Right.
that's probably where it stops. Where you've got a self-managed super fund, the investment flexibility is much greater. You can invest in shares, in managed funds, in artwork, crypto, currency. I mean, the list, property, of course, commercial property. The list goes on. You can't borrow in an SMSF, but there is one exemption, and that's around real property.
Right.
And that's where you've dealt with clients and strategies and helping them into property through this type of structure. But
can you explain, Marcel, the cash flow, how it would work, how it's all within the self-managed super fund? So, for example, if it was an investment property, how all the income and expenses would be covered in the self-managed super fund?
Yeah, so in the same way as if it's an individual,
right?
So the fund is an individual in its own right, so it does its own income and expenses,
right?
So if you've got rental income going in, if you've got contributions going in, that's all income. The expenses coming out might be, if you do have a borrowing, the interest or the repayments, administration fees for running the fund, they're all expenses. So it works in the same way. If the expenses are 1,000, if the income's 1,000 and the expenses are 500, well then the 500 that's left over, that's the profit, and that gets taxed.
Right.
At the fund tax rate, which is and this is probably one of the biggest things, is the tax rate's only 15%.
Okay, wow.
Versus building assets in your own name, which is up to 47%.
Yeah. So I think the average income would be on that 30 cents in the dollar.
Yes.
So what you're saying, you could put your income into here at 15 cents in the dollar.
Essentially, yeah.
Yeah. Halving the tax.
The biggest downside though is that you can't access it.
Right.
Yeah. Likewise with a normal retail fund, you can't go on withdraw money. Right. It's the same with this. Even though you might have direct access to the bank account because you're the trustee, or you can transfer money, you control it, you can't access that money. They're very highly regulated. The ATO has released some guidelines around how much you should have.
Right.
So, upwards of 250, 300, 500,000 might be the required amount.
Right.
And that's only the first hurdle. So there's a lot of rules that you must abide by to run a fund. And
I guess that's where you come in as a financial planner to give that advice. Can you explain the statement of advice, the purpose, and the reasoning behind that, and how that protects your clients?
Yeah, absolutely. So it all comes down to whether it's appropriate for the client, and if it's in the best interest of the client. So they might sound great on paper, but if it's not appropriate for the client, then we wouldn't set one up. Even if the client really wanted to set one up for whatever reason, it really needs to be Because at the end of the day, I mean, you can set up a just a normal fund and run that, invest it well, and that can do really well. And that's part of our process. What we do when we're talking to someone about an SMSF, we stack that up against just going the normal route, see where that lands, and stacking that up against the strategy that we're looking at, whether it's a residential or a commercial property, and see where that lands over 10, 15, 20 years and how they compare. Because there are a lot of upfront costs with the self-managed super fund. But it's a good strategy for the right person and with the right objective.
Yeah, I guess some of the benefits I've seen with clients in the past is, you know, they may not have the borrowing capacity to buy an investment property or an asset in their personal names because they might have maxed out their borrowing capacity.
Yeah.
If their chosen asset is property or shares, they've got another avenue to invest in property with their super, and it's in a separate environment, which is very good.
Yeah, it's all, like I said, if it all stacks up and it works, then yeah, we'd definitely look at it. Another to the point of, you know, building assets inside and outside the superannuation environment, we've come across clients where they've bought all these properties and have all these assets outside of the superannuation environment, and that's their retirement plan, which is great. But when they get to that point of retiring, all that rental income will be forever taxed.
Right.
So it's almost like, well, for these clients, why don't you come and see us after 2 or 3 properties? We could have purchased the other 6 or 7 in the fund.
Right.
And when you get to retirement, all that rental income is completely tax-free.
Right.
So, but yeah, everyone's different and everyone has different circumstances. So,
and could you cover how the super fund is audited each year and the purpose of that and how that works?
Yeah, that's part of the normal process for a fund to be audited annually. Just like yourself, you do a tax return every year.
Yep.
The fund has to do a tax return.
So your accountant would do the tax return for the
So there's specialist SMSF administrators who look after the accounts.
Right.
But then you also get some accountants that do that as an added service as well.
Right. Okay.
So
I guess it just shows the importance of having a look at those different structures before we invest, whether it's property or shares, and getting the right advice. Because we're learning now that there's a lot of implications and there's pros and cons for each of the 3 main structures.
Yes.
And I think one of the other things to consider is if we do get it wrong up front and we have to change the ownership structure, it can be very expensive.
I've been there a few times, where the trust option looks really attractive because the property, the clients are at that stage, but to change 3 or 4 properties over into a trust, there's like a couple of $100,000 there in stamp duty alone.
Yes.
But anyway, so starting early, so
getting it
right.
Getting
it right from the start.
Fantastic. Okay, so I guess the security blanket a financial plan will give you the ability to take advantage of the different investment strategies and options, as we know and Marcel talked about. You've got a range of investment options, but it's finding out that best way of investing. The peace of mind knowing that you're not relying on the pension, that you've got other options and other avenues.
Yes.
Because I think, you know, going forward, relying on the pension in the next generation is going to be pretty scary. And the government's going to really have to look at how they can afford that. And in Australia, we're actually pretty privileged when you look at the rest of the world, you know, that we do have a government-funded pension. But I believe that in the future, and if you speak to anyone that's living solely on the pension, it's a pretty tough gig, you know, like they're really struggling with the cost of living going up.
Yes.
And I guess that's another thing, a reason court action is because we talk about, you know, friends and family and clients about everything's costing us more now, you know, petrol, food, groceries, our mortgages, interest rates have gone up, doubled. So we can't work any harder. So we've got to create these passive ways of income and asset growth. So we're not concerned about whether, you know, petrol goes up or a mortgage goes up a bit because we've got other assets growing in value that can help offset, I guess, those rising cost of living that we're going to face, you know.
Yeah, absolutely. And there's that part of starting early, but there's also that part of just getting some good guidance or advice on even just the little things like selecting the investment option in your super fund.
Yes.
You know, over the years, we've come across clients where You talk to them and you go, oh, she's probably a growth investor, or you make an assumption. But then you look at their strategy, and their fund might show it's sitting in cash or something very conservative.
Yes.
And then you ask them about it, and they say, well, that's just a decision I made 6 or 7 years ago. Meanwhile, the last 6, 7 years have had the best returns on record.
Right.
And clients have, through these decisions they've made without any guidance, have missed out on 2 or 3% per annum, which on a balance of a couple of 100,000 or $500,000, that's a big deal.
Yes.
Over time. So just sitting down and talking to someone and getting some guidance on, okay, this is what I'm doing, is this right, or what should I do, or we want to work towards this, how should we approach it? Just having that conversation can make a huge difference.
Yeah, and I think I can really relate that. You gave myself and my partner a financial plan, and we were getting, closer to retirement, pretty concerned about how we're going to fund our retirement. And the first thing you did was do a risk profile.
Yes.
And me and my partner, we were both very different in terms of risk. So the way you recommended investment varied between ourselves. Our assets were different. So you put an individual plan together, but we could work towards a common goal. But it gave us a lot of clarity, peace of mind that, hey, we're not in as bad a situation as we thought. And you gave us a plan. You told us where we needed to invest, how much we needed to put into these asset classes, as well as property, super, and shares, and investing to get us to that, as close to that retirement goal. I guess it was quite a scary thing. We talk about breaking this total sum down into manageable figures. If we say we need $1 million or $2 million at retirement, that's quite a scary thing, and most people will just close the book, forget about it. It's not the right way. You've got to break it down. You gave us a very detailed plan, how much we actually need to invest, put aside each week on top of what we're doing to get to that, that financial goal of retirement. So that gave us a lot of clarity and a lot of security,
Yeah, and that's right. I think that's the key, breaking it down into manageable figures, because you're right. If you just went out and said, oh, guys, you need 2 million, that's not a great start. When we do prepare a financial plan, we look at every strategy, we look at what opportunities there are, tax minimization. But again, coming back to starting early and compounding can make those large sums possible over time. So so I'm glad you got something out of that.
Totally. It's my partner was very concerned about going into retirement. She was had a lot of confidence from your plan. It was very detailed. It took us some time to put it together, but the results and that's the importance of just thinking that we need to do something. But when you get an independent professional in and saying this is what you've got to do, these are the steps, and there was a number of steps, changed our banking system and the way we put money into different accounts. But you showed us the result from doing that if we kept that that plan. So it's a guide and keeping us on track. I think with anything in life you need coaches. And it's probably something I personally hadn't thought about in my financial plan with running a business as well, and a family. You sort of put those things off, but I think it was we had a lot of peace of mind from that. From that security side, highly recommend it.
Very good. So where are we? Compounding effect. So this is a great slide. There's a lot going on here, but we'll just focus on the starting balance. So the bottom line is the years 1926 through to 2020, and the left-hand axis is the value of the money invested growing over time. So basically, we're looking at $100 back in 1926. If invested in either residential property or Australian shares at those rates, gets to about 1.6 million, which is absolutely mind-blowing. It is 100 years, but we're starting off at $100 here. So that's a crazy number. But I think the takeaway from this is just that compounding effect. I think the other takeaway as well is just how closely Australian residential property and Australian shares are correlated over the long term. Yeah,
even I was surprised by that. And you see some years where the share markets outperform the property market, and other years vice versa. But overall, the result, the return, 10.7, 10.9%, pretty incredible. That's a year on year, and that's people talk about economic crashes and things. We've seen global recessions. We've seen GFC. We've seen share market crashes. I remember in the 90s. We've seen natural disasters. But again, the overall average
Yes.
is very strong. You're not going to get that by putting money into the bank or
Yeah, no, exactly.
relying on a lotto win,
Yeah.
So it's just that, as they say, time in the market,
Yeah, absolutely.
and the importance, I guess, of we all know about the years where properties haven't gone upwards; they've gone down in value. Shares have gone down in value, and we know people that have sold their properties when they weren't seeing the growth.
Yes.
And then look back over a few years when the market did grow again and regret that selling decision. So I think it's that having that financial plan and say, this is the plan, you've got to stick to it, guys. We know overall the market's going to recover at some point. As long as the fundamentals, I guess, that you invest in the type of shares, the type of property is fundamentally strong, it's a long-term growth.
Yeah, absolutely. And we have that on our side as well when it comes to managed funds or shares or superannuation, where people panic naturally when things go bad. But it's what you do after that. It's if you sit tight and just let things play out under the advice of under the guidance of your advisor, of course. But what a lot of people without that guidance or advice along the way, they panic and they sell out, or they change from shares to cash or to bonds, for example, and they miss out on the recovery. And then they switch back into that. It's a terrible cycle.
And I guess that's when, a classic example, recent example of that is when, COVID hit and we saw those media news, sensational news about property prices were going to drop by 20 or 30%. Some people that hadn't entered the market held off. Some people sold their assets down and, blew us away with the growth, 20-30% capital growth over the last 2 years in most areas, So those people that sold their assets or didn't purchase the next one, look back now and there was a lot of cost in that. Sitting on, I think at the moment right now, I speak to a lot of property owners and investors, and a lot of uncertainty, with interest rates rising, of course, and the cost of living going up. We're really not sure what's going to happen. But when you listen to those economists and look at the fundamentals of the Australian property market, in particular in the share market, the fundamentals are very strong. Property, we've got strong population growth, lack of rental properties. We've got population growth. I know here in Queensland it's quite severe.
Yes.
Finding a rental property is pretty tough.
Yeah, it's very tough.
So the fundamentals are very strong, but probably market might go up or down in the next 6-12 months. But long term, it's going to perform very well.
Yeah. Okay, so let's move on. I'll let you talk through this slide, Geoff.
Okay, this is a really interesting one. Comparing the growth of Australian property compared to the rest of the world since 1975, and quite staggering. You can see the blue line. Australian property market, has just outperformed the rest of the world in a huge margin. And of course, you've seen years there where the property market, of course, has gone down. But when you've seen those other years where the property market has really recovered and performed very well. So comparing the Australian property market to the rest of the world, Australia has really outperformed, the rest of the world. And going forward, that's why I'm speaking to more international investors in the last 3 months than I've ever spoken to in the last 10 years. And I've seen that. I think that security of the Australian economy, we've got a very safe economic environment. Our banks are very secure. Property is very stable. And it's a very safe country economically and financially. So I think that's a really surprising chart. And it just shows you why, the Australian property market has continued to perform, pretty well over the longer term. Australian house prices, we looked there since the 1960s, and we've seen some phenomenal growth. Of course, we've seen years where the property market has dropped in value, but again, it's just that compounding effect of holding on to the property. A bit like Warren Buffett said, he buys when everyone else is selling.
Yes.
And he sells when everyone else is buying. So, when there's fear around, he's buying because he's buying assets below market value. I think it's right at the moment, there's a lot of fear around. Those that are taking advantage of the market at the moment are going to do very well in the long term, So again, just come back, don't think of the last 12 months, 6 months, think back the last 5 years, 10 years, 20 years, and go back to those charts and that information. For history, it gives us a bit of a guidance of why that compounding effect,
Yeah, absolutely. I was just going to say, yeah, I just recalling some discussions with clients that are buying property. Right now, just in our market, I guess, the competition has dropped off quite a bit, so you can actually negotiate at the moment.
Yes,
which has been unheard of for the last couple of years.
yeah, yeah. I think I source some of these small lot development sites for clients and individual homes, new properties, and across the board, there's less buyers in the market.
Yes.
The days on market are growing out a little bit, and everyone's a little bit more negotiable. You've got more time to actually look and consider the property. So I think it's actually a pretty good market. Recently secured some great deals for clients because of that. There's less competition, less panic around. So,
yes.
People will get over that fear and get back into the market. So right now, I think there is a bit of a window for opportunity that those see the strong benefits. Okay, I'll leave this to you to explain.
This is quite a busy one, and I won't spend too much time on this, but again, it's just showing, I think the main thing here is the different asset classes. Australian shares, international shares, and then you've got US shares only, Australian bonds, listed property, cash, CPI. So when we construct a client portfolio, it's very well diversified. So we've got exposure to all these traditional asset classes.
Right.
So we're not in the business of, shooting the lights out with returns. We're a slow burn type strategy where it's focused on a long-term outlook. But yeah, again, just another chart showing the growth of $10,000 over, in this case, over a 30-year period. And there's lots of ups and downs along the way. But you can see there the difference between the starting value of 10,000 right up to 2022, which is just mind-blowing, even regardless of the asset class that you may have invested in. So let's move on to the next slide. So back to you.
Yeah, so I guess, where do you want to be at retirement? We've talked about the impact of not doing something, or the benefits of taking action. Never too late to start that the investing journey. And the reasons we need to do so are really, really important. Again, especially we're seeing the cost of living's gone up dramatically. The cost of our biggest expense is generally our mortgage.
Yes.
Interest rates are pretty much doubled to what they were 6 months ago. So even more reason why we need to create these other income sources, this passive income, so that we can go ahead into the future and not having to panic and really reduce our living standards. So like Nike says, just do it. I think, having a plan in place, looking at the fundamentals and making that decision, talking to the specialist, such as Marcel, getting that plan, finding out where you are now and where you need to be at retirement, whether it's 10 years or 20 years or 30 years away. And then have that plan that's implemented by the financial planner, and then actually sticking to that plan,
Absolutely.
So what will your future looking like in 10 years if you don't take action today? So we all, talk to friends and family about the property next door we should have bought 10 years ago or 20 years ago. I think we've all got stories about that, and look back to why didn't we buy more assets at those days? We can't go back, but we can make a decision now for the future.
Yes.
And I think those that, sit on the fence, like COVID, people that sit on the fence really, I think, would have regretted the decision by holding off. Now we're in a similar situation where there's been a lot of changes in the markets, and I would always go back to those industry experts that have seen lots of cycles over the years. I listen to a lot of podcasts and information from those that are investing themselves, those that have seen good markets and bad markets, and look at come back to the fundamentals, and having the right strategy, having the right asset class, and buying in the right structure that we talked about.
Very good.
Okay, so I hope everyone's enjoyed tonight's information and got a lot of value out of the content, and seen the real importance of why we need to take action and do something to change our future. The Australian property market in particular is forecast very strong. There's an article on 7 News yesterday, actually, quite surprising, talking about Sydney property prices and they're forecasting them to double by 2030. So in 8 years' time, and forecasting another surprising fact. I think the Gold Coast will be the most expensive house prices in Australia.
Yeah,
so,
I still don't know about that one.
yeah, I don't know either. So, but it just shows you, the fundamentals. We've got population growth, and I think another big thing for us to consider in terms of real estate is that this international migration that we haven't seen obviously for the last 3 years. And I've spoken to a couple of immigration specialists lately.
Yeah.
And there's a huge amount of people trying to get back into Australia. Yeah. Expats, and also these international people that see the value in the Australian economy, and where the people that the Australian government's going to allow in are going to be highly educated, highly financial. Yes. And they're going to be buying assets here. So they're going to put, pressure on prices because of the more demand. So again, go back to those fundamentals, have that long-term strategy in place. So if you would like to have a discussion about property, in the chat box, there'll be my link where you can go into my calendar, or you're welcome to put a comment. Please call me. If you'd like to speak about financial planning and have the advice from an expert that I've personally used myself, I'd highly recommend you go in and we're going to put Marcel's contact details up on the screen. It'll also be in the chat box. Welcome to give them a quick contact and have a discussion. So there's the contact details there. So would you like to add anything further, Marcel?
Yeah, happy to take just general questions, just to have a discussion and provide some general advice. Just maybe even just point them in the right direction, and just go from there.
Yeah, and I know you deal with clients, we've had mutual clients right around Australia. So I know you're based here in Southeast Queensland, as myself. But we have clients right around Australia. So obviously technology is great now. We don't,
it's not really an issue anymore. It's much easier.
Changed world technology. Thanks to COVID. So okay, great. So we're just going to open up the chat box and check the questions in there. And as I mentioned earlier, if you've got any specific questions, you're welcome to type them in the chat box or any general discussion, and we'll be able to answer those. And so our details are in the chat box. You can just click on the link. And thank you. Nishan's mentioned it was a great session, interesting insight. Thank you, Geoff and Marcel, for organising. You're welcome, Nishan. So I hope that sort of added some value to your thoughts and process. And given this is coming from a property specialist, I invest in property myself, and a financial planner who's I can speak on very highly behalf. We work with mutual clients sometimes, and it's not just the property, it's not just the financial advice, but I guess the point is, whatever you're doing in life, you need professionals, and having that advice. We talked about investing, so you need a financial specialist to help with the lending. If you're going to borrow funds, if it's an asset class like property, you need someone that understands the property market and those vacancy rates, those growth locations. If it's into super or shares, you need a financial advisor that can recommend, do your risk profile. That's something I learned, like when you look at us, and you ask very, very detailed, specific questions to find out exactly what we were looking to achieve. So you could give us the right guidance based on ourselves, not a generic person,
Yes.
So I guess that's the point of having that individual discussion with yourself to find out where they are and what position they're in. Yeah,
that's probably the most important, that initial meeting, to get an understanding of things. That's one from Lewis there.
Okay, I'll let you answer that one, Marcel.
A quick discussion about living in the property the SMSF owns. Can family live in it? Oh, that would be good if you could. But there's a little rule called, or a little thing called related parties. So the short answer is no. You can't have family or anyone that's related to living in an investment property that's owned by an SMSF. I reckon that goes on. People that think they might be a little bit sneaky, but big fines. I would not even go near risking that. It's completely prohibited. It's against the law. So yeah, the short answer is no. I mean, even things such as I'll give you an example. I run my own SMSF. and I own some artwork. Now, I can't even have that artwork in my home or office to view it.
Wow. What's the point of having it?
That's right. Hopefully the value will go up. So that's in storage. So it even goes to that extent where you can't even have the pleasure of viewing a piece of art that US NSF owns.
Wow. Yeah. And if you've got things like assets like that are, do you have to get those valued or assessed every year, or is there any?
I don't know if every year is right, but I guess if the price is changing and it's a significant change to the value, then we would. But yeah, with artwork, I mean, I get one gets insured and gets valued anyway. So yeah, it's depending on the asset class.
Okay, and just furthering on that question that Louis asked about living in the property. So what happens if you've got the property in your self-managed super fund and you get to retirement? Can you move into that property at retirement, or is it still a separate asset that you can't access?
Yeah, if you get to the age where you've got access to your super, you can potentially do an in-specie withdrawal out of the fund.
Okay.
You can't live in it while it's still in the structure.
Right.
It needs to be extracted from the fund via withdrawal. A lump sum withdrawal out of the account.
And would that transfer into your personal name then, the property, or would it?
Yeah, so that's a good point. Stamp duty, the change of ownership.
Right. Okay.
Yeah, you can transfer it. Yeah.
So I think that's why, a big thing of getting it right from day one when you're purchasing the asset, because there's a lot of consequences, I guess, if you change it into a different structure.
Yeah, but in saying that can be a strategy as well for people to go, well, this is general advice, of course.
Yeah.
With the concept of buying a property with the intention of one day retiring in that property.
Right.
It's a big call to make, because normally you might look at that strategy 10, 15 years out. And as we know, things change along the way. So that might not be the right property when you get to that age, but it's something that can be done. Yeah.
Right. Okay, so let's see if we've got any more questions. I think we've answered all the questions there. Yep. So thank you everyone for attending tonight's event. Again, this is put on to really as an education and to share the content and information. And it is generic in nature, but I just really implore everyone that uses the video and time to really look at what your asset class is in and what action you need to take.
Yes.
And think about that retirement, because I know myself getting close to retirement, it's a concern for myself. I think about it every day, and working on how to build those assets. So I think, we are in a very fortunate position in Australia. We've got some, great laws. We're a very safe country. People have created a lot of wealth out of property and shares. So the potential is there, just having that guidance, that professional guidance to say, this is what you're going to do. This is a plan. And more importantly, have someone like self, implement and say, explain how that plan is going to work.
Yes. Yeah. Absolutely. Very good.
Okay, well, thank you everyone for attending tonight.
Thanks for the questions.
Yep. Yeah, thank you everyone. And we will be recording, we have been recording tonight's session. So as long as that technology works well, Lisa will email that out tomorrow as a newsletter. And again, if you want to get in touch, you've got my contact details. And if you'd like to contact Marcel, you've got details on the screen, or you're welcome to contact Marcel. So
yeah, absolutely.
Thank you for your attendance tonight. Got a lot of content myself out of the event tonight. I'm just going to end the session. So thank you everyone for attending, and have a great evening.